It is Tuesday, which means it's time for the $1 trillion show. And I'm your host, Neil. With me is Serena. She is my master of all things that I don't want to do. I always like joke about like that. Like we were on a call with a client earlier, and that's how I introduced Serena. But no, I really mean it. I just give everything to her. She takes care of it. So yeah, she's the co-host here and keeps me on my toes because I have no idea what's coming.
Thank you.
Yeah, but this is the $1 trillion show. And what do I mean by the $1 trillion show? That is the mission. I want to save $1 trillion in taxes for Americans. Now, that's different than all the Doge stuff, and we're going to talk about Doge today. And Doge is trying to cut down on the spending. I want to cut down on the receiving so that we squeeze the government for all it's worth, basically. And the way we do that is by reducing the tax burden on you and me, all of us private citizen Americans. And the more money that's in our pockets, the better, as far as I'm concerned. So that's the kind of the short version of how I look at taxes. The more that you keep in your pocket, the more I keep in my pocket, the better. And there are people who disagree with me on that, and they're just not clients. And that's okay. So how do we do that? Obviously, we could not have that many clients. We do client work for sure. We help people save tens, sometimes hundreds of thousands of dollars a year on their taxes. But we're still not going to get to $1 trillion that way. So the way we do that is through technology. And so we scale tax saving strategies through technology. We've got worksheets, we've got courses, we've got AI tools, and more is being developed all the time. This last week, I was working on a tool that shows you, if you have a small business, it shows you how much of the thing that you sell you need to sell in order to support the lifestyle that you want to get out of it. It'll tell you how much you have to spend on marketing and advertising. It'll tell you how much you have to spend on internal systems operations and a whole lot of neat stuff and things like that. That it'll even show you how much you need to save for taxes, which is where we can come in afterwards and chip away at that number and increase your standard of living by reducing your tax burden. But that's the kind of stuff that we're working on, and it's a continual work in progress. And yeah, I'll show you how to jump into some of that stuff a little bit later. And this is me, Neil, and I got into taxes because I owed the IRS over $1.3 million way back when. It was back in 2007. I started getting those letters. And by 2009, I had enough because they started taking my paycheck. And so I had to fix my own problems and got myself into this crazy tax world so that I figured out how to save small business people primarily. It works for other types as well, but our main focus is small business people because that's where the most people are and the most people who have the most leverage. And those people are also not being served by the current status quo in the tax business or in the industry of tax professionals. So that's how I came to this tax planning world, and that's how we do stuff. So what I talked a little bit already about some of the tools. Starter course is one of them, and I'll show you where you can join the explorers and find out about the starter course. So we have a couple intro courses. Starter course is one of them, and it is like the intro to tax planning. We have another course that was just released last week, but we haven't really promoted it yet. And it's all about taking you from step zero, where it's okay, I want to start my own thing. I have an idea for a business. It could be online, it could be personal services, it could be whatever. And it goes through how to set up your company, how to set up your bank accounts, and then how to implement basic tax strategy, how to do the basic bookkeeping kind of stuff, and then arrange things so that your first money that you make is as tax efficient as possible. And then after you start making more money, then at the end we talk about scaling up and becoming a bigger thing. All right. Usually right here, I dive into questions because I know the answer to all tax questions. The answer to all tax questions is, it depends. However, before we get there, I do want to talk about something that happened since the last show. Let's see. I'm going to ask Grok about it because now I have Grok 3 that rolled out, I think, today. What is the latest on the Doge efforts to reduce the IRS? All right. So let's see what we got here. Is that showing the right screen? Yes. Okay. Let's see. As of February 18th, 2025, the Department of Government Efficiency, Doge, led by Elon Musk and Vivek Ramaswamy, although I don't think Vivek's involved anymore, is actively pursuing efforts to reduce the federal workforce, including at the Internal Revenue Service, as part of a broader initiative under President Donald Trump's administration. blah, blah, blah. So reductions in force, offering buyouts, yada, yada, yada. Okay, so here's the bottom line. We know that right after Trump got into office, there was like 1,300 or 1,500 IRS employees that just resigned. And since then, combination of layoffs and buyouts, they are expecting about another 15,000 people to be no longer part of the IRS. And it seems like they are going after the newest hires first. So if you're there less than 2 years, you're in like one category, and they're just basically getting wiped out. So what does this matter? It's basically 20% of the IRS workforce is going away. Now, what effect does that have? And it's debatable. How good a job were those 20% doing? I don't know. I do know that we have clients that we have sent in forms, original filings, we've sent in amendments, we've sent in responses to notices, and things have just been sitting for months at this point. And I can't imagine that's going to get any better with 20% of the workforce being laid off. Expect things to be slower, basically. If it's something that requires a manual, like a physical person doing something, I'd figure it's going to be slower than ever. If it requires calling the IRS, normal wait time during tax season is like 2 hours, and then half the time they hang up on you as you get to your place in line. But it's probably going to be 3 hours or 4 hours or something like that. That is definitely the downside. The upside is that audits will probably be reduced just because they have fewer people to do stuff with. That is the plus. And yeah, that's what we're looking at. Basically, anything that is not electronically filed through the modernized e-filing system is probably going to take longer. And that's just where we are. Hopefully, you don't need to do anything regarding to that, but it's just a wait and see game as far as all this, because I've been following people arguing on Twitter about this whole thing. And as people are complaining that the IRS personnel, like the head count is bloated, they're inefficient, and they're using antique systems. That is all true. I don't think that's actually going to change by firing people. So it's not like the people that are left will suddenly be doing a great job. They'll be doing the same bad job, but there'll just be fewer of them. That's my take on it, anyways. Hopefully, I'm wrong. I guess I'm a bit of a cynic after dealing with the IRS for over 15 years now. So, yeah, I just wanted to hit that news and make sure that people are aware of that. So if you're waiting on a response for something, just expect to continue to wait. And try not to get mad at us.
Right, it's not our fault.
Like, we send it in, and then it's in their hands. That's all we can do. All right. So back to all questions, all answers to all questions when it comes to the tax world. It depends. With that, what do we have up? What do we have up first, Serena?
So we have a tax law change question. Someone wants to know, are there any expiring tax credits or deductions that they should be taking advantage of right now?
Interesting question. Okay. So we are in the final years of the Tax Cut and Jobs Act. And the big things that are being affected there, and I've talked about this before, but the big thing for most people is bonus depreciation. So that's getting stepped down. For the first several years, we had 100%, then it was 80%, then 60%, 40%. So that is being lost. However, Congress right now is they're negotiating a new tax bill. And we talked about that last week about the Trump tax initiatives. And they said they want to extend key provisions of the Tax Cut and Jobs Act, which is, I'm almost willing to guarantee that is going to include the bonus depreciation. So that's expiring, but in a bad way, in that we are getting less bonus depreciation than we used to, and hopefully that will be fixed. Because it's just, what it really does is it's trying to put taxpayers on a more accurate cash basis. So in the accounting world, there's two primary ways to look at your books. One is accrual and one is cash. So accrual is you book either the income or the expense when you incur it, regardless of when the money hits your account or leaves your account. Cash basis is the opposite, where you only book things when they actually hit your account. So most people operate in a mostly cash. If you have a day job and you work, let's say you get paid every 2 weeks, then as you're working during this pay period, you are expecting a paycheck at the end, but you don't know for sure that it's coming, because when companies get in trouble, sometimes they don't make their payroll, and Friday comes and goes and say, hey, where's my money? You have an expectation on an accrual basis, but the reality is on the cash basis. Does the money hit your account or not? So when it comes to bonus depreciation, then you're spending, let's say you buy a piece of equipment for $10,000. That $10,000 left your account. And so on a cash basis, you want to write that expense fully off. And that would be 100% bonus depreciation. If it's a 5-year property where you have to depreciate at 40% this year and then 20% of the remaining 60% each year after that, then that's just not, it doesn't feel real. And this gets people confused when it comes to accounting profits versus book profits versus cash in your pocket. By trying to align those things as closely as possible, then we get into a situation for small business where it makes the most intuitive sense. So that's one that's expiring. The other things, there's always like random stuff, but the big change, or one of the big changes this year and last year, was the vehicle credits. So that's not an expiring one. That was a revamped credit. That the old one went away, the new one came in, and now we have credits both for new car purchases, but also for used car purchases, which we didn't have before. So that already went away, but came back better. The residential energy credit, that was another thing that went away and came back better. Let's see. Yeah, for most people, the biggest issue coming up is the bonus depreciation issue. Along with the Tax Cut and Jobs Act expiration, there's a whole slew of other things that are set to expire. So qualified business income deductions, the estate tax limits that had been doubled being halved, and a bunch of other stuff. Standard deductions versus exemptions, all these kinds of things. However, with the caveat that all of these things are currently under negotiation in Congress. I don't think you have to worry too much right now until we get an actual tax bill that is passed and put into law, hopefully within the next couple of months. So yeah, that's where I would leave that one. Nothing too crazy right this second. As we get an actual piece of legislation, we'll keep you up to date on that one.
Okay, sounds good. Looks like we have an NFT question. Someone wants to know, what's the tax impact of selling digital products or NFTs? NFTs, sorry.
Yeah. So those are it depends. Okay, so here's the thing. Those are two different questions, digital products versus NFTs. So let's talk digital products first. So digital products could be anything. And I mean anything in the tax sense. It could be capital gain, it could be collectible, it could be ordinary income. It just depends on what you're doing. NFTs, so for those who don't know, NFT stands for non-fungible token. And in the cryptocurrency world, so you have fungible tokens, which are like cryptocurrencies. So Bitcoin, for example, more or less, if I give you a Bitcoin and I have another Bitcoin, they're interchangeable. That means they're fungible. One can substitute for the other. Non-fungible things are like trading cards or pieces of artwork or things like that, where one is not a substitute for the other. Last year, there was an opinion piece put out by the chief counsel of the IRS. I think it was back in March of last year. And basically what the opinion said was that you should do a look-through analysis. And what that means is that you don't treat the NFT as a thing itself. You have to look at what the NFT represents. If it's a piece of artwork, then you're dealing with collectibles. If it is a piece of a security, then it's, capital gain kind of event. If you are in the business of buying and selling NFTs, then it's ordinary income because that's your trader business. So you have to look through into what the NFT represents. And then you have to figure out, okay, how am I using that asset for tax purposes? And it could be anything, literally. You have to figure that out on a case-by-case basis. Most people are just using them as collectibles. Now, the interesting thing about collectibles is that there's a special tax rate for collectibles, which is 28%. So that's higher, and it's a flat 28%. So capital gains, if you're, depending on your filing status and your total income for the year, your capital gains rate might be 0%, it might be 15%, it might be 20%, it might be 23.8%. But collectibles is always 28. So it's higher than even the highest long-term capital gains rate, and there's no brackets to it. It's just 28. People are, I would say, 99% unaware of that particular fact. And if they're reporting their NFTs at all, they're just reporting them as regular capital gains, those stuff. So yeah, no, that's a long way of saying it depends.
So it depends, guys. So we have a pet question. A
Pet?
client wants to
Yeah.
know, can I deduct my pet expenses if I use my pet for security or business marketing?
Interesting. So
It
the
depends.
usual does depend. For security, if it's real security, like you have Dobermans and it's beware of dog and all that kind of stuff, I could see that making that case. If it is, what was it about advertising or
Yeah, so business
marketing?
marketing.
Yeah, if you're in a business where that is a normal thing, then sure. If you're
Right.
not, then that's a stretch. If your brand is, hey, I'm the dog lover guy, you can make that work. But if it's, hey, I clean pools, oh, I also have a dog, that's not going to work.
The pool.
Yeah, probably not. The other angle for pets is as a therapy support animal, emotional support animal. So you can get, and this only works for dogs. Can't be cats, can't be fish, can't be, it has to be dogs. So you can get your pet trained and licensed as a emotional support animal, and then you can work that into medical expenses. And then that may or may not dovetail with other medical expense strategies if you, again, if you are running your own business, that kind of stuff. There are ways to skin a cat, but with dogs. So yeah, it depends,
But you
but
can't do that with the cat.
no, it has to be dog.
The dog.
Yeah, and I don't like dogs personally. It's never gonna work for me, but so I know a lot of people do love their dogs. But I've always been with cats, and the cats love me.
Understood. Me too.
Yeah.
Understood. So it looks like we have a question about the Secure Act 2.0 rules. So someone wants to know how does a new Secure Act 2.0 rule impact retirement contribution?
Contributions, whether it impacts the limits, those are adjusted every year anyways. So
Okay.
the main things with the Secure 2.0 Act was with money coming out. If you inherit an IRA, you have to defund the IRA within 10 years. There was a whole thing about can you do it at the end of the 10 years or do you have to do it throughout the whole 10 years? And we finally got clarity on that a year or two ago, saying it has to be each and every year. You got to defund the account. It moved the RMD age from 70 and a half to 72. Did it have any effect on contributions? Off the top of my head, I can't think of any major changes to contributions other than the just the dollar limit figures being adjusted. I will have to look into that and get back to you.
Oh, it looks like increase the catch-up contributions for ages 60 to 63
Okay.
through 63. Mandatory Roth catch-up contribution for high earners, and then automatic enrollment and escalations.
Okay.
So it did help a few things. And lawyer matching for student loan repayments,
Yeah, that's just
emergency saving withdrawals.
on the withdrawal side. Was the $5,250 for student loans that was in the Secure 2.0 Act?
Yep.
I thought that was a different bill. Okay. That's a fun one. I wrote some articles about that actually. It's on our blog about Section 127 plans and say underutilized strategy. So before that legislation, you could, and Starbucks was famous for this. Even if you were a part-time employee, they would help you pay for your schooling or college, whatever. But I guess it was the Secure 2.0 Act that allowed those same kind of arrangements to be paid towards student loans. So that was a new thing that, potentially could be a tax-free benefit for employees of up to $5,250. And it could be done where the employer pays the employee, that money, the employee turns around and pays the student loan, or the employer can actually pay the student loan directly. And it's an expense to the company as an employee benefit, but it is not income because it's just turned around and spent on student loans. Now, the only I hesitate to even call it a gotcha on it is that if you are the employee in that scenario, if the employer is covering your student loan, you don't get to deduct the interest on your personal taxes, but you didn't pay it, so that's why. That's the only thing you gotta keep aware of. But yeah, it's a great tool. But yeah, so like catch ups and all those kinds of things, those get adjusted constantly. And Secure 2.0 Act, I guess, adjusted some of those on top of that. Yeah, so from 50 onwards, you get 10,000, and then 60, you get an extra 3,000 or 3,500, something like that. But to not need that in the first place. But that's
Yes.
probably a separate conversation.
Yeah. Oh, a whole nother webinar. Looks like we have an IRS and compliance question.
Okay.
Someone wants to know, how does the IRS treat cash transactions over $10,000?
So the IRS doesn't treat that at all. They don't care. If it's income, you got to declare it. If it's expense, you just expense it, just normal. The people that do care is FinCEN. That's the Financial Crimes Enforcement Network. That's under the Treasury. If you deposit $10,000 in cash, and the bank will typically have to fill out what they call a suspicious activities report. They'll ask you, "Hey, where'd you get the money?" And basically they're trying to look for money laundering and drug trade, essentially. Now, people hear that and then they say, well, if that happens when I deposit $10,000, I'll just deposit $9,000. And that is a different thing called structuring, which is also illegal. So there is no loophole here. So if you intentionally deposit things in a way in order to evade these kinds of forms and questions, then that is the crime of structuring. And there was a case, oh, it was probably 10 years ago now. There was a defense attorney in North Carolina who was prosecuted for that and ended up going to jail because of it. So don't do that. If you transact in cash, it's fine. Just treat it like anything else. But just if you want to deposit it into a bank, that's your option. And if you do, and the teller asks you, "Hey, where'd you get the money?" Say, "Hey, I sold my car," or wherever the source of the money is. Just say whatever the source of the money is, and they'll write that down on a form, and it will get submitted to the government. And then just know that you have to make everything square when it comes time to file tax returns. So where people get into trouble is if they're trying to cheat the system. So if, let's say, I run a convenience store and I deal with a lot of cash and some credit cards. So credit cards goes through a third party. I'm not going to be able to play with those numbers at all. If, let's say, $300,000 comes in through credit cards, then my tax return needs to show at least $300,000. But the cash, if I brought in another 50 worth of cash, do I report the full 50? And the answer is yes, you report the full 50. So if you are dealing with cash, then you put it in the bank account and you say, "Hey, I made this at my store," and then that doesn't line up with the receipts that you are reporting on your tax returns, that's where mismatches can occur and that's where investigations can begin. So just play by the rules and you're fine. And you have the extra hassle of the banker asking you a couple questions when you deposit the cash, and that's it. Now, whether you want to deposit cash or not and trust the banks with your money is, again, a whole other conversation.
Yeah.
Because if you look on my YouTube channel, there's an old video of probably like 2000, something like that, of me talking about how bank deposits are not yours because they're not. So under US case law going back to 18 something or other, when you deposit money into a bank, that money is no longer yours, even though your name is on the account. That's a loan that you give to the bank, and the bank may or may not ever pay you back. Okay. Most banks, how do I want to say this? The US financial system is structured in a way that you'll probably be fine. Let's put it that way. But we live in a fractional reserve banking system. And so when you deposit, that money is not there for all intents and purposes. But it's functional. The system is functional enough that you can probably get your money out when you need it. So I personally recommend having a cash on hand for emergency savings and that kind of thing, so that should things happen, if there's a blackout or some kind of banking holiday or whatever, you actually have cash that you can put your hands on and be able to use in those kind of emergency situations. Take your measure of where you are on the paranoia scale and act accordingly.
And do things legally.
Yeah, just if you want to deposit, go ahead and deposit. Just report it like you would
Report
any
it.
other like you would report any other income that you are required to report.
Okay.
Yeah.
It looks like we have a GoFundMe question.
Okay.
Someone wants to know what's the tax treatment on GoFundMe donations?
If you are raising money for a business of some sort, then it's going to be revenue. If you are doing a GoFundMe to do a product launch and you're doing Kickstarter does these a lot, where it's, "Hey, pre-buy my thing for $100," then that's just revenue, and that has to go towards whatever income activity that's associated with that. If it is, "Hey, I have medical bills, please help me," then those are going to be gifts, and the receiver of the gift is never going to pay tax on that. And if it's under, what is it now, $19,000 a year, then the payer doesn't have to fill out any forms either. If it's above that threshold, then you have to start doing gift tax returns to attribute that gift against your lifetime exclusion of whatever it is, $11 million right now. Might be 13 million now. That's one of those things that's expiring with the Tax Cut and Jobs Act, which might get extended. We'll see. So yeah, so for GoFundMe stuff, that's going to be the two basic arrangements. It's either gift or it's going to be revenue for some kind of business activity.
Understood. Looks like we have a hiring my spouse question. Can I
Hiring
hire
what?
my spouse? So it
Okay.
says, can I hire my spouse as an employee and pay them a salary to lower my taxes?
Not to lower your taxes, but yes, you can. So, well, let's rewind that a little bit. So,
Yeah.
if you file jointly, your income and your spouse's income gets combined. So, it doesn't really matter if it comes to you or comes to your spouse, with certain exceptions. There can be situations where the spouse needs earned income in order to qualify for a particular tax credit or a particular benefit of some kind. So, those can be edge case scenarios where it's better to put the spouse on payroll. If you're filing separately, then who knows, right? Because it depends on the separate filing situations. And I have seen cases where that does work out, but you got to really analyze what's going on at each level there. So sometimes the quickest way to explain this. So when it comes to paying the spouse, there can be benefits in terms of retirement contributions because if the spouse wants to contribute to a 401k, you need earned income or an IRA or SCP, or there's different flavors, but retirement accounts pretty much all require earned income. And if you have a lot of income, it might be better to have the spouse earn some so that you can max out that account, and you earn some so you can max out your account. So the total max of retirement contributions is greater than on the single. So that can happen. Flip side is that if you just pay yourself, you might max out your Social Security tax, and if you have to spread the wage out over filer and spouse, then you might not hit the Social Security cap, or you might pay twice as much Social Security tax. So there's a lot of competing elements there as far as will that reduce the overall tax liability. And so it really depends on what you're doing and why you're doing it. Some people will pay more tax today in order to get more money into a retirement account just because that's what their future expectations are. And if that's the case, then sure, you can go ahead and do that. And just know that you're going to have a payroll tax burden associated with that. So, yeah, it's a whole lot of it depends in that kind of case.
Depends on your scenario.
Depends on your scenario, depends on your goals, depends on your filing status.
Understood. And then we have a real estate question, Neil.
Yep.
Someone wants to know if I rent out my house on Airbnb for less than 14 days, do I have to report that income?
Yeah, that is, if it's under 14 days, you come under the 280 AG exclusion. Yeah, there's been guidance saying that you are supposed to report it and then you're supposed to exclude it. Here's the thing. The statute doesn't say anything about it, just says it's excludable from taxable income. The guidance says from the IRS says, yeah, you should put it on the form and then take it off. In a post Chevron world, guidance does not mean what it used to mean. I'm always reminded of the Big Lebowski. That's just like your opinion, man. It's debatable how important it is. In any case, as long as you follow the guidelines established by Section 280, then you are not paying tax on it. And then you can quibble about under this set of rules you should report it. Under this set of rules you shouldn't report it, and you can argue with the lawyers about that one.
It depends.
It depends.
It
Yeah.
depends. So,
Also, one other thing that it depends on is that depending on the numbers, you might not want to exclude it. You might want to take, because if you exclude the income, you also exclude the expense. And there might be cases where your expenses outweigh the income and you want to declare both and capture both sides to reduce your overall taxable income. Depends.
really depends,
Yep.
right? Okay,
Yep.
understood. It looks like we have another question that came in. It says, what happens tax-wise if I barter my services instead of receiving payment?
You think you found a
Tricky
loophole.
question. Yeah.
And the answer is that's not a loophole. If you do barter, you are supposed to report that just like it's any other kind of income at the valuation of the goods or services that you receive. It's very hard to determine that though. So it's let's pick a really trite example. Okay, so I help my neighbor mow his lawn, and in exchange, he helps me, or he doesn't even help me. He helps my wife babysit my kids, right? Something like that. So we've exchanged services. Those services have some sort of market value. You don't really know what though. And so how do you put a number to that? And At that level, we're talking about tens of dollars, right? So it's not going to be significant in the grand scheme of things. But the principle is still constant throughout, is that as a U.S. Taxpayer, you are required to report worldwide income from all sources. And so receiving bartered services would be some kind of income. And then you would have an expense of whatever you have against that. So it is reportable. It is, in the vast majority of cases, impossible to determine. Where it might be traceable would be like if you have a commodity. So let's say you're trading like gold for, I don't know, baseball cards or something. All of those have market values, and you can actually pick a number. So that is, theoretically more traceable than just random personal services. So you could put a number to that and then include it in your other income. It's funny. This is what we call Schedule 1 income. So you have your 1040, then you have the Schedule 1. Schedule 1 is adjustments, basically, positive and negative adjustments. And in I don't know if it's in all tax software, but in the software that I used to use, there was like different line items, and one of them would be for barter, and one of them would be for proceeds from illegal activities. If you are selling drugs, the IRS wants you to report it, and if you don't, then that's a whole separate charge they can get you on. Because that's how they got Capone, right? That's the old story. They didn't get him on murder, they didn't get him on racketeering, they got him on tax evasion because he didn't
So now
report.
reporting the drugs he sold, right?
Yeah, the all the things that Al Capone used to charge money for and never reported on his taxes. Barter comes under the same kind of stuff where you're supposed to report it, but how do you value some of those things? It's very difficult.
And I'm just curious of how he would have reported that. Just
What's funny is the states that have legalized marijuana, they have this problem where it's under section. So we talked about section 280A earlier. There's section 280E, E like echo, where if you have a federally prohibited thing that you're selling, marijuana, then I think it's specific to Schedule 1 and Schedule 2 stuff, but I'd have to reread it to be sure. But basically, or you have to report your gross sales. You're allowed to deduct cost of goods. So if you buy it for $10 and you sell it for 20, you can deduct that 10. However, you are not allowed to deduct anything else. So no operational expenses. So salaries, rent, utilities, all that kind of stuff you're just not allowed to deduct it. And what that ends up doing is that increases the cost of all those operations by the tax rate. Because in normal business, you deduct that and then you pay tax on the remainder. But if you're not allowed to deduct that in the first place, then effectively you just have a higher tax rate. It's a area of under the Biden administration, we actually thought we were going to get a law that was going to change that regulation, but never happened. And under Trump, probably not going to happen. Yeah, the people who run those kinds of stores, even though they're state legal, they're not federally legal, and they're still in this wacky tax regime. So theoretically, Capone should have done that, and he would not have been convicted for tax evasion.
that's really crazy, right?
Yeah, it's crazy.
Thought of that.
Yeah.
It looks like we have an international question.
Okay.
Someone just wrote in and said, if I work remotely for a U.S. company but live abroad, do I still have to pay U.S. taxes?
Maybe.
It depends.
So it depends on your nationality, depends on where you're doing the work, depends on, I mean, those are the two primary things. So if you are not an American and you are not performing services in the United States, then most of the time you're going to be taxed under whatever that local jurisdiction is. But that's not always the case. It's going to depend on the tax treaty, one, if there is a tax treaty between the US and wherever you are, and it's going to depend on the arrangement of the US entity. So if the US entity is here, domestic, and is paying somebody foreign and there's no tax treaty, then there's going to be foreign withholding under the recipient fills out a W-8 BEN, and then the payer is going to withhold usually 30%, might be less depending on treaties, all this kind of stuff, and then it's going to file 1042s with the government each year with the withholding reports. But if the company is there and paying over there, then you're not going to be in that situation. So the details really matter when it comes to international stuff, and it depends. But yeah, so it gets more and more tricky as things become more and more virtual. So you might have a company in Wyoming paying somebody in, I don't know, Uganda as an engineer or something. And that person in Uganda has no tax ID in the US, has never stepped foot in the US. Are they performing services in the US? And you got to figure out, based on the relationship between the two countries, how that all gets treated.
All right. Looks like we have a stock question. Someone wants to know if I inherit stock, how is my tax basis determined and does it change if I sell them quickly?
The basis doesn't change. Now, when you inherit any asset, and this is true so far, this was under question during the Biden administration, but they didn't get anything done. So, when you inherit an asset, it is your cost basis is the value on the day that you inherit. Now, this can be screwed up. So, it has to be through an inheritance. So, if grandma is old but still alive and you put the house in your name, you didn't inherit it. It was given to you. That's a different thing. If somebody passes away and it goes through probate, and then through that process you acquire title to a thing, that's an inheritance. And whether or not it goes through probate is a whole thing for the estate lawyers. But yeah, you got to make sure that you are, somebody passed away and then gave up title to an asset and then you acquired it. If somebody gives it to you, then in most cases it's going to be the basis at which they acquired it. Most cases. But for inheritance, it's going to be market value on the day of that you inherit. And then, so if you sell quickly, then chances are your gain is going to be zero. And so whatever proceeds you realize from that are going to be effectively tax free. In fact, if it's something like a house, you might actually create a net loss because of closing costs. But if it's stock sale, in the old days, we used to pay commissions as a percentage basis on stock sales. But these days, with the so-called discount brokers, which is now just all brokers, trading fees are, either zero or very small. You're probably not going to have much in the way in the way of sales expenses. But if you inherit $100,000 worth of stock, sell it the same day for $100,000, your gain is zero, and you have no tax, but you have an extra $100,000.
So it depends. Awesome. And it looks like we have a wash sale rule question. Someone wants to know, how does the wash sale rule work and how can I use it to my advantage?
So I've got two ways to use it to your advantage. So the wash sale rule is, so let's say we just had that same scenario. You inherit $100,000 worth of stock, you sell it, and then 15 days later, you decide, you know what? I actually want that stock. I think it's got a good future. I'm going to buy it back. If you do that within 30 days, then it's like the sale never happened. That's what a wash sale is. It's like it's a wash. We're canceling out the purchase. We're canceling out the sale and then subsequent purchase, and we're collapsing them into a single thing so that it effectively never happened. So this bites day traders a lot because they're buying, selling, and the brokers keep track of all this and say, okay, did you buy and sell the same thing within 30 days? Yes, you bought and sold the same thing within 2 hours. And so all these trades might be canceling out when it comes to tax reporting. That can be an enormous problem for people sometimes. But that's the basic idea, is that you cannot buy back within 30 days and have the sale that you started this whole 30-day period with count. Where it comes in is, most often anyway, is tax loss harvesting. So tax loss harvesting is a strategy where if you have gains that you've sold off throughout the year, then usually towards the end of the year, you'll look at your portfolio and say XYZ stock is down, $10,000. So I'm going to sell that one, and that's going to reduce my other gains by $10,000. Now, maybe I still want to hold XYZ for the long term, but it's just down right now. So I have to wait 31 days at least. I actually recommend waiting like 34 days just to be sure with settlement, because there's 3-day settlement stuff. And then if I buy it back after that, then my sale counts because I'm outside the wash sale window and I have reestablished my position at a new cost basis, whatever the cost is at that future date. And we go on about our way and we're able to capture that loss. So there is a relatively new service called FREC, F-R-E-C, that has elevated tax loss harvesting to an art form. I still haven't funded my account over there, to be honest, but this is something that I've been planning to do. What they do is they do direct investing. And what that means is that if you buy a mutual fund or an ETF, let's say the S&P 500, that's the most common one. If you buy the S&P 500 ETF, you're buying a single thing that represents ownership in those 500 other things. What FREC does is say, no, it's the modern age. We don't need to do that anymore because we have computers that can control all this stuff. So what FREC does is it actually takes your money and buys the 500 things directly. and weighted according to the index and all this kind of stuff. And over the course of time, they will sell stuff. And they will sell things that are in losing positions in order to capture that taxable loss and build up your tax loss harvesting. And they will automatically wait the appropriate amount of time in order to buy back into those issues so that you don't trigger wash sales. So it's a really cool platform. And again, I have not funded my account, but I do have an account in there. That is something I will be doing over time. And what it does is that it basically makes your eventual sale of different things either more tax efficient or tax free because those losses just build up and up and up. It's a really cool piece of technology and a great example of how the things that we used to do manually are just being, what's the word, outdated, or I don't know what the word is that I'm looking for. Mutual fund exists and the ETF exists because it makes ownership of more complicated structures easier. But if you can just direct your computer to buy those other things anyway, you're cutting out the middleman to a large degree. It's pretty cool stuff. I
So
will.
this is fine. So we have a Puerto Rico question.
Uh-huh.
Someone wants to know what happens if I move to Puerto Rico and can I pay zero federal income taxes if I do?
You can, yes. So this goes back to originally it was called Act 20 and Act 22, and then they passed a new version called Act 60. So Puerto Rico is a federal territory, it's not a US state. And under the rules thereof, people in Puerto Rico who earn money in Puerto Rico do not pay federal income taxes. They pay Puerto Rico taxes, which is worse. Puerto Rico taxes are higher than federal taxes. However, in order to incentivize investment into Puerto Rico, they passed these laws. Again, originally Act 20, then Act 22, then Act 60. And what that is that if you set up shop in Puerto Rico with a company that provides services to US domestic companies, so the US domestic company does pay federal tax, or its owners do, if it's a flow through, then the income from the US domestic entity flowing through into the Puerto Rican entity is not taxed in Puerto Rico. So it's not taxed federally and it's not taxed in Puerto Rico. So pretty close to tax free. And then the general strategy is that the owner of that company in Puerto Rico will then take a dividend from that Puerto Rican entity and pay a 4% capital gains tax there in Puerto Rico. So that's the basic idea. So you effectively have a net 4% tax rate. Now, there are lots of conditions that go along with this strategy. So one is you got to live in Puerto Rico for at least 6 months and a day during the course of the year. And then depending on the year, they change the rules a lot around the auxiliary stuff. So like when they first started, you had to employ 3 people locally. Some years you've had to buy a house. You've had to invest like $10,000 into an approved charity. And I always wonder when I hear stuff like that, it's like, who's running that charity? Is it your local mayor down the street, who runs that charity? I don't know. That's how the basic arrangement is though. So US company customers pay Puerto Rico entity for services rendered. That's all tax free. And then the owner of that Puerto Rico company who lives in Puerto Rico for at least 6 months takes a dividend out of the company and pays 4% at that level. So that's the basic arrangement. Can be done. We've seen clients do it. I've seen clients give it up though. So we had one client who lived in Puerto Rico for a couple of years, decided between the cost of living in these areas has gone up so much because of all these Americans taking advantage of this strategy that the tax savings isn't really worth it. So he actually ended up moving back and just a regular domestic federal taxpayer now again. Other people who works really well for is people who have family in Puerto Rico. So we have one couple, husband is not Puerto Rican, wife is, and they moved to Puerto Rico. They've got small kids, grandma's in Puerto Rico, and so that situation worked out really well. And he was able to pay little to no tax. It wasn't no tax, but it was relatively little. And yeah, he saved 200 grand in taxes by doing that. On YouTube is asking about FREC direct indexing, product similar to Wealthfront direct indexing. So it's direct indexing is that product of buying those stocks directly rather than through an ETF or mutual fund. I don't think the Wealthfront has the tax loss harvesting aspect to it. I could be wrong. All right. So that actually brings us to the end of the hour. We are at 6:56 here. So in the last couple of minutes, I will say, if you want to learn more, go to this link, taxsherpa.com/explorer, or scan the QR code. That'll take you to the same place. It's our free group, and that is where you get a lot of our tools, a lot of our courses. So one that I just released, I don't know, 2 weeks ago, that's a freebie for everybody, is being non-passive in real estate, so you can maximize your real estate deductions. Another one that I constantly refer back to, and we did this today actually, was the partnership. So basically, I wrote a book on the 13 questions you need to answer between you and your partner before you go into business, because no partnerships last, none, zero, because either somebody's going to retire, somebody's going to die, or something worse is going to happen. And there are things worse than those other two. You have to have an exit plan before you go in, so that you don't get caught unawares. So there's a bunch of tools like that in there, and again, more being added all the time. And you can, if you want, at that point, you can buy into the starter course, or you can buy into the Navigators. The Navigators is our higher level offer where you get everything all included, everything's free, and you get weekly calls with me on Thursdays. And the other two things is that next week, on Thursdays, in addition to our weekly call with the Navigators, we're having a monthly call on profitability. So that's going to be next week at 2 p.m. for all my Navigator folks. And then in 2 days from now, we're actually having a webinar at 8 p.m. Eastern on Thursday, and that's going to be with the Shred Method. So the Shred Method are these guys who created a software tool to pay down your debts really fast and mathematically optimally, and then using their banking connections in order to make that work for you as well as possible. Really cool stuff. I was actually playing around with the math earlier today, and I said, okay, if we create a tax strategy that saves you $5,000, then you had just an average credit card and an average mortgage, and you took that 5,000 and applied the Shred Method to this debt paydown cycle, what does that do? And actually, over the course of the particular parameters that I estimated, it saves $17,000 in interest, which is, a lot more than five. It's when you start to layer things in together and combine strategies, things get really powerful really quickly. And that was just a single $5,000. That's not just the $5,000 every year in savings that we create with a lot of our clients, or 10,000 or 20,000 or whatever. So check that out. If you get on the Explorers, you'll get notified of all those kinds of things that we are doing, because we're doing a lot of stuff behind the scenes.
Yes.
So with that said, that brings us to the end for today, and we'll do it all again next week. And there is it next week? I might be wrong about that. Let me check. Okay, so next week, yes, regular show. 2 weeks from now, no show, because I'll be in a workshop on book writing. But next week we will have our regularly scheduled show at 6 p.m. Eastern on Tuesday on our live stream page, on YouTube, on X. I think Facebook still is not working. I think LinkedIn is working, but yeah. So we'll see you guys there. Catch you later.
All righty. Have a good day.
All right. Bye-bye.